Hi, it's Brian Resney. It's question and answer day. And one of the questions that I receive often is about what happens when you have a down year in the overall stock market. Is the next year potentially really good? It could be. In fact, we're going to give you a chart that basically shows what happens kind of midstream in any calendar year. If I go back 20, 30 years and I look at most calendar years, we've had pullbacks in the equity markets. And that pullback, some of those have been 5, 6, 7%. Some have been 18, 19, 20%. But it didn't mean the markets ended negative for the year. It just means mid-year or sometime within that time frame, you had pullbacks in the equity markets. This is normal and natural. It's what you do when you have a pullback. Do you go to cash? Are you scared? Are you emotional? Do you run an investment strategy? Can you cope with volatility is ultimately the question. Smart investors and investors ultimately that make a return on their money have a long-term structure, meaning they're not looking at the next quarter or 1 year. You need to look at 3 to 5 year time frames, in my opinion. Remember, I've been managing money almost 30 years. I've seen ups and downs. I've seen my clients make a lot of money, and the key to making money is it's not every single year is consistent. Some years are really good, and some years are kind of mediocre. But at the end of the day, over that rolling 3 and 5 year time frame, investors tend to be very happy investors. You as an investor have to realize not every month or quarter goes up. Short-term thinking and emotions are going to ruin your return on your portfolio. And the chart that we're showing, of course, shows over the long term some of the pullbacks we basically have had in a calendar year, only to basically have recouped those losses and gone higher. Remember, volatility is natural, but it's how you handle it. And ultimately, the real risk to your portfolio is the next recession. Is there one coming in 2016? I don't know yet, but we are watching our indicators closely. If we feel and we see what's happening and the economy actually is showing signs of recession, then at that point it would make prudent sense to trim equity-based exposure and get very defensive. We don't see that yet. We may not see it in 2016, but we watch this data on a daily basis. If you're not a client of our firm, it's time you became a client. Call us for a consultation. Let's talk. Let's discuss your portfolio. Have a safe and profitable day.